Happy Thursday, y'all. Let's go. Interest rates ticked up a little bit this week for obvious reasons. The average top-end buyer's right now at 6.13%. I'm going to keep beating this drum. I don't think we'll see major improvement in rates from here. These are all the major forecasts, mostly at 6% or above, with a few outliers as low as 5.5%. And remember, folks, most of these are the market optimists. Another reason for concern is that mortgage rates track inflation. The Producers Price Index came out this week. Inflation for both service and manufacturing companies are up from 5% the previous year, now with cost for service firms up 7% and manufacturing firms up 8.5%. Something to note is that the biggest increase came from health insurance, and this actually caused wage increases to be about 1% lower. And the thought on producer inflation is that it is thought to eventually pass on to consumers. Headlines continue to show that we have a housing inventory problem, which is keeping prices higher, and these are national analysts, and that's true in many places, but you can see inventory across all the South Census region is up since 2019, which is the last reasonable market, with Texas having the highest increase at 42%. Here's also a graph of new build inventory for that same region, decreasing quickly in the last few months, but still high. The Fed's Beige Book posted some responses from builders saying that activity ticked up but still slow, price discounts are still widespread, high level of speculative inventory on the market, and continued downward pressure on prices. What does this mean for you? Rates are still unlikely to drop, sellers need to be realistic, and buyers have a negotiation opportunity. However, I will also say anecdotally, this market has picked up with a lot more activity. As always, if you have questions about this data or buying a house, let me know.